Good morning, guys. You're most welcome to today's episode of the Market Snapshot. Today is the 17th. Today is the 17th of January 2024, and I'll be taking you through what's currently happening over in the markets. So I think to start it off, the most important thing I think is yesterday's comments from one of the Fed governors, who is a Fed Walla. So, the markets have been rallying on anticipation of expected rate cuts from the Fed. But we saw that yesterday, we saw a bit of like pushback on that narrative of potential rate cuts. And also the Fed rate cut bets were also pushed back for after the comments that Fed Walla made. We saw that also after NFP's data and also the inflation data, which we got last week. We saw that most of the risk on assets have actually been in the red because that narrative seems to be sort of like cooling off as we start the year. I think the main event that markets are waiting for some kind of solid guidance on where we are likely to go with regards to potential rate cuts will be on the 31st of January, when we are going to have the very first Federal Reserve conference of the year, which is going to be on the 31st of January. So it will kick off with two meetings that will be on Monday. That will be the Monday the 29th. And then those meetings will then conclude with a conference on Wednesday. So I think if there's going to be any solid pullback on any moves on the risk on assets, most especially the indices, that is really going to be confirmed by the guidance you get from Powell. Now, of course, the markets are also waiting to hear on what the Fed has to say or what the Fed committee will have discussed after we listened from Powell. There has been some indications that the conflict that we're having taking place right now in the Red Sea seems to be kind of affecting a lot of things. We're also seeing that if you check there's a website I think you can use to check how the shipping containers are moving, but a lot of the US containers have had to divert their route. Previously, they were using or going through the Suez Canal, but now they have to go all the way to South Africa, okay? And they are doing that all because they want to avoid any kind of attacks from the Yemen's Houthis. So, of course, the other thing is that from the comments you get from Fed Walla, he didn't really say that there's going to be any cost implications from that current conflict, but those are just his comments. So we need further guidance from Powell on what will come out from that. Yeah. So for now, it's just a wait and see. The other thing, of course, that we are seeing in the markets is if you look, those of you that have been trading gold, you notice that gold has had some kind of a pullback. Gold seems not to be pricing in, that war premium. We saw that gold actually bought a bit last week on Friday. We saw it after the NFP. The CPI report that showed that CPI for December had increased from 3.1% to 3.4%. That was the CPI headline number. We saw that immediately after that, gold pulled back. And of course, then after pulling back, it rallied on Wednesday, rather on Friday morning, when UK Prime Minister's Rishi Sunak indicated that they are going to take part, or they are going to send their military to take part in the fight against the Yemen's Houthis. So it's immediately after that we then saw gold moving back. But now, after yesterday's comments from Fed Walla, the market seems now to be, pulling back, and we're seeing a lot of risk on assets selling. We're seeing gold selling, silver selling. If you cross over to the crypto space, a lot of them are also pulling back. Of course, if you look on the bonds across the world, the bonds are actually rising, pricing in that potential, slow pace of rate cuts that is expected as we go into the year. So I want also take us to the COT report to currently see what is the current positioning in the market for gold, because I know a lot of you, most especially those of you that are trading gold, this might be important for you. So when we look at the current COT report, we are seeing that actually the open interest is more heavily on the side of the short positions for gold. And as you can see, the swap dealers are currently having 250,913 positions, and you're seeing that that open interest is currently standing at about 51%, which is the highest for this particular report. And of course, this is as of the 9th of January. So indicating that there might be some kind of leaning on for short positions for gold. So when we also focus on seasonality, around this time of the year, normally gold usually buys into January. It did the same also last year, but usually towards February, we usually see gold pulling back. We are not yet in Feb, but you can see that we are actually halfway through the year, and rather halfway through January. So it might be a time maybe for positioning to change. Yeah. Now, let's also focus on the Japanese yen. The Bank of Japan, I know for my JPY traders, if you're trading GBP JPY, if you're trading USD JPY on the 25th of this month, the Bank of Japan will be meeting, and they are going to give us some guidance on whether they are going to consider switching from their decades-long, easing policy, or QE, and to see if they are going to start hiking rates. But for now, the positioning seems to be a bit mixed for Japanese yen. We are saying that on one hand, there's there's a high open interest for short positions. We are seeing it at about 39%. But also when you switch over to the long positions, the asset managers or the institutions are currently holding 32.8% for open interest, which means there's some kind of a mix there. But though, if you look on your charts, we are seeing that the market is leaning more towards actually an actual push lower for JPY, and we are seeing that reflecting, especially if you're trading GBP JPY, you must have noticed that there's actually some kind of a lean on for an upside move there. Okay, so let's cross over to the calendar and see what is happening today on the diet for the economic data. So this morning we received two sets of important data. The first one was the GDP for China. The first GDP set was the GDP year over year, and we saw that China's GDP, much as it came in below the forecast of 5.3%, it is still much as it came in lower than the previous, or 4.9%, higher rather, and of course slightly below the forecast. We are still seeing that, of course, the market is not responding as it should. Yes, there have been some indications that China is actually, undergoing some kind of a slowdown, and the same is also reflecting with the indices. If you check on China's indices, they're at levels that they have never been at since 2019. So there have been some indications that the Chinese government may come and intervene and possibly also do what South Korea did. If you notice, South Korea actually halted short selling, okay? And China's government has tried to do a lot to try and boost the stock market. Last year, they also reduced the tax for trading stocks. They cut it in half. And of course, that did not help to boost the performance on a stock market. So we are yet to see what interventions they're likely to do, because it seems the investor sentiment is not so good over in China. Now, we also got the Chinese industrial production, which we saw increasing from 4.3% to about 4.6%. Retail sales slightly declined from 10.1% to about 7.4%. We also see that the Chinese unemployment rate ticked higher slightly by 0.1%. So now the other key data which we have is the core CPI for the UK, rather for England. We also saw that it actually increased from 5.1%, rather from, yes, it's actually stayed unchanged at 5.1%. They expected it to decline, but it actually stayed high. Now, for some context, if you click on the core number for inflation for the UK, you notice that actually last year, the UK's inflation decelerated quite a lot, and it actually moved from about 7.1% down to 5.1%. So previously, the issue was inflation should not stay too high for too long, because if it does that, it may not be good for investor confidence, and also usually high inflation erodes the value of the currency. So we'd want that the currency at least still stays fairly stable. Now, any increase on CPIs for the UK is going to be good for the pound, unless, especially if it does not increase too much. If it increases slightly, but still stays down, that is going to be a good thing. So those of you that are trading GBP/USD, you notice that after this data was released, there was a nice spike on GBP/USD. For those of you that, of course, were with us on Monday, and my Ugandans who are listening, who came to the academy, we also gave guidance for CPI, and we indicated to you that in case you get a higher CPI, it should be taken as bullish for the currency. PPI, however, seems to be a little different, because it seems to have remained well anchored in a negative territory. As you can see, it is still a negative. So the PPI also for the US, which came out last week, showed us the same picture. And it's not yet clear whether the same is going to reflect on CPI, but it seems PPI data is going to be coming in negative, which could indicate that maybe there's some kind of a slowdown. Now, the narrative has also been indicating that most of the economies are going to survive a hard landing, which of course they thought was going to come as a result of the rate hikes, but that didn't happen. But we cannot yet conclude on whether the hard landing is out of the picture. So we'll have to wait for a series of data, possibly maybe into the year, for us to see whether it's actually going to survive these economies are going to survive any kind of year. So for today, we have retail sales. So retail sales, again, is going to be, sort of like, it's going to follow up on the CPI data we got. If you notice, we had CPI data that came out last week. The CPI data came out quite positive, which was not much of a surprise for traders, simply because usually December normally comes in with very high, December normally has usually has increase on inflation due to several factors. Most importantly, that the holiday sales. Yeah, so the increase in CPI also for the UK, not much of a surprise, especially for December. So I'm expecting retail sales most likely are going to be sharply high for the US, and we should see some bit of a buy for the dollar post-release. Also, if you're going to be trading into the release, you might want to stay dollar bullish as you go into the release of the data. So we are now in a period where we are getting a lot of Fed speakers. And as you can see also today, we are going to have FOMC member Bauman speaking. So Bauman might build on a narrative that has been, created by Fedzwala. He might indicate to us whether the Fed is still going to consider rate cuts, and of course, what traders will be focusing more on will be the timing. What is eluding us is the timing. The timing is what we are not sure of. The timing is what traders are waiting for. When are we going to get those rate cuts? Are they coming this month? Are they coming? Are they going to be coming maybe? The next time they meet, which is going to be in March. When the rate cuts? Okay. Last year, especially towards the end of the year, we saw that there was really strong buying for GBP/USD, EUR/USD, AUD/USD, and several of those risk-on assets. And of course, the reason for that was the anticipation of the rate cuts. Now that has dwindled, and now traders are waiting for something actual. Okay, when are they actually going to cut? And the less we get of that, then the more the markets will start pulling back. Yeah. So crossing over to see what else we're having. We have manufacturing production, which is coming out at 5:15. Manufacturing production, we are going to get that data. We're going to get that data coming out at 5:15. So should we get an increase there, then it should be seen as a bullish indication for the indices. But I don't think we are going to get that much of a reaction here. The traders will be focusing more on the comments from Bauman. Okay, so either Bauman is going to build on Fed's Waller's narrative, or he's going to switch and say, we are still focusing on looking at higher rates now. We also have the 20-year bond auction. We have been seeing a lot of reaction to these bond auctions lately. You notice that the previous bond auctions we have been getting for the US have not been coming out that great. We've been seeing that the auction yield rates have actually been dipping quite strongly, which explains why we saw the indices and the stocks benefiting quite strongly. Whenever you have a lower auction yield rate, but also a lower bid to cover ratio, it just indicates to you that there is less competition. The competitiveness at the bond auction is not as high, and usually that is seen as a bearish sign for the dollar. Should we see a higher auction rate here, then we could see some bit of a reaction there for the dollar. But I believe us having Bauman speaking today is going to be much of a bigger, sort of like a bigger focus than that auction rate, which the auction yield, the auction which is going to take place today. So having said that, let's first cross over to trading view, because I want to show you guys what is happening with the fear index. So I know some people may disagree with me, but I've been having a kind of a feeling that the VIX is suppressed to a certain level. But yesterday, I was actually quite surprised when I saw the VIX recovered quite strongly. And we are seeing that right now it has actually priced in, that kind of fear and and of course, uncertainty that comes usually around this time of the year. Of course, speaking also of the tensions that are happening with the Red Sea, I know a lot of tensions are still heightened over there. So we are seeing that now we started the year around here, somewhere around here, sorry. Okay, that was around here. The first day of the trading day for the year was the 2nd of Jan. So now we are seeing that the fear index is trading at about 14.57, simply indicating to us that there is a possibility that maybe we should see some bit of rise here for the fear index. So should we see it spiking, then we might continue to see some kind of a pullback for the risk on assets. As you can see, everything is in the red. If you look at Dow, DAX, NAS 100, most of these assets are in the red. And the reason for that is because of first of all, some bit of fear, but most importantly, because of Fed Waller's comments yesterday. So let's cross over to the charts and see what is happening and what trades we can take today. So I'm going to start with GBP USD. So GBP USD, again, right now it is trading about it's trading about 60 pips from that release of the CPI data. And I'm expecting that we should see a continued move higher. But any pullback here is really going to depend on potential on how the retail sales come out. Should we see a weaker retail sales number, then we should see GBP USD recover quite strongly and possibly head back to this level that it was at on the 7th of January. Now, when I cross over to Dow, I just want to point out that Dow Jones still has a debt to pay on the higher time frames. So when you go on the weekly, I've been eyeing this fair value gap here for quite some time. And of course, this gap was created because of that frenzy, the frenzy buying we got from the Federal Conference, that was on 13th of December. So this weekly candle, much of the contribution to this weekly candle was only because of one particular day, which was the 13th of December, okay? So now, when this candle was created, we noticed that Dow Jones peaked at 37,800. It revisited that level 3 times, okay? It revisited that level 3 times, and after revisiting that level, we saw that its average trading price since the start of the year has been between 37,200 to about 37,400, okay? As of now, we are saying it has actually broken that level, and it's expecting now to head back to this fair value gap, which is quite, it's still there on the weekly, okay? So when you move to the H1 time frame, this is what we are having. On the H1 time frame, let's just switch there quickly. Give it a moment. Okay, so on the H1 time frame, if you zoom in a bit, you'll be able to see that the level that has to be taken out before we conclude that there's a change of trend for this particular asset, and it's now time to start selling it, is this level where we have the 37,025, okay, which is somewhere around here where my arrow is. So until we get to this level, the sellers are not going to kick in. Now, taking into account that we have the Fed speaker, rather a Fed conference on the 31st of January, I'm expecting that the market is going to keep bouncing off these levels here, okay, where I've marked my boxes there, okay? The more we bounce off those levels, the likelihood it is that we are going to create another lower high somewhere around here, possibly maybe somewhere around today or sometime next week. And when we do that, we're going to now come and see if we can reach this level here. So this move here is majorly going to depend on the comments that we get from Fed Baumans today. Should we get any indication of any kind that the Fed is going to stay with rate hikes, rather with rate cuts, and possibly if it indicates that the rate cuts should happen sooner, then the market will start buying back, okay? But we have to come and fill that gap, possibly maybe that might happen sometime within this week or next week. So let's cross over to the NASDAQ. So on a NASDAQ on the weekly, NASDAQ is different from Dow Jones. And why I'm mentioning that is NASDAQ does not have any debt, okay? It does not have any debt on the charts. It cleared all its gaps that were created from that Fed conference on the 31st of December. And since it cleared them, it has now started buying back. And you notice, okay, my chart is taking a little long to load. My chart is taking a little long to load. Just wait for it to load a bit. Wait. Okay, so this is NASDAQ's FVG, okay? That was created. Now, when you go to Dow Jones on a weekly, you'll notice that this candle here, ever since this candle was created from that strong buy we got on 31st of December, okay? NASDAQ came and tried to clear. It actually paid part of its debt here. That was in the week, I think the first week of January, okay? It sold and cleared all this gap that was there, and now it still has that to clear, okay? Sold, bought back, and you can see that the pullback that we have been seeing on the Dow Jones is not as aggressive as the one we have seen on the NASDAQ. Reason for that is because there are no pending sell orders. NASDAQ came and cleared them, went back up, and it is now comfortable there, okay? The two are not in sync, NASDAQ and Dow, simply because of that reason. That's why the pullback on NASDAQ is going to be very gradual, okay? And also some of the tech heavyweights, like NVIDIA and AMD are actually supporting a higher move for the NASDAQ, okay? So should we get weak earnings? We're expecting earnings for NVIDIA and Apple to be released soon. possibly if we get weak earnings, then we could see a pullback for NASDAQ back to this area here. And when it does clear that, then it will now start a downtrend. But for now, it's still fairly up there. Okay, let's just move to the H1 time frame so that we can see what is happening on the H1 time frame. Just a moment. My computer is a little slow, so just waiting for it to. Okay, so this is the H1 time frame for NASDAQ. Let's just go there quickly. Just a moment. Okay. Okay, so this is what we are having on the H1 time frame. Now, I'm expecting that we should see some move, a little move higher for NASDAQ, possibly back to that area of 16,900. And that is potentially going to be on the back of higher earnings. Now, in August, when we had previous earnings, what happened is the last time when we had those, before we had the earnings, we saw that there was actually a pullback to come and create some kind of a discount before the earnings were released. But that happened towards the end of the earnings season, especially before NVIDIA and Apple released their earnings. So the same might happen today. We might see an aggressive sell on the NASDAQ, possibly taking it back to this level around here, okay? Somewhere around here. So we might have a sell, possibly come and test this level, okay? And then possibly start buying back, okay? You notice that if there's not any order flow for buys today on NASDAQ, if there's no order flow for buys, then we might see that there will be some selling that may come in and come and press NASDAQ back to these levels here. But for now, the bullish momentum is quite strong for it, and I'm expecting that it's going to stay with a potential strong uptrend. Now, let's quickly move to gold and see what is happening on gold. I know gold is a big interest for a lot of us. So let's check out gold as we wind up. So for gold, I know a lot of us are thinking, why is gold selling this much, even when there's a war going on? So it has something to do with, it has a lot to do with the pricing in, okay? Gold's war premium was created on Friday. We saw it actually buying and going upwards of 20,057. If there are no more escalations of that war, then it just gives us an indication that now it's now time to sell. And that's why we are seeing gold pressing down. If you are in the snapshot from the start, I showed you what the current standings are for gold future positions. Traders are heaping up on short positions for gold, and that is providing a lot of downtrend momentum for gold. So I'm thinking we should see gold pressing lower. Around February, we should also see gold potentially breaking below these levels here, downwards of $22,000. But for now, I'm still expecting that we should see a bit of a recovery for gold, possibly back to this level here. It's going to recover up to this level, create possibly another lower high. And when it does that, then its selling might resume back to this level here. Now, if we happen to get strong retail sales earnings today, it's going to provide very strong downside for gold, okay? Reason being is that usually strong retail sales are normally seen as bearish, and I'm expecting that that is going to provide a lot of pressure to the downside for gold. But for now, we should see it trending lower, okay? That's what I'm expecting. So now for Euro USD has been quite choppy, but I'm expecting that since it's in an uptrend, we should see that uptrend possibly continue with a few pullbacks here and there. Now, you notice that the reason why I've drawn these lines like this is because I'm trying to factor in those areas where it pulls back and comes and fills these areas. So on the H1 time frame, Euro USD has a clean range. Okay, a clean range is simply an area where you have price coming and creating something like this, where it sells, and when it does it, especially when it has when the fundamentals are supporting it, but also if we have a lot of liquidity sweeps and indecision, it just gives us some kind of indication that there's going to be some recovery. Okay, so I'm expecting that we should see a potential move higher if you manage to break this area. So yeah, so if we manage to take out this level, then we should see Euro USD recovering possibly back to this level here. And if it manages to hold price action there, then maybe it can come and get back into its uptrend. Okay, the uptrend is actually in this area here. That's what the uptrend is. It's within this area here. So we should see how it does today. Now, this move back here for today is also going to depend on the retail sales. If we get strong retail sales, then it will be a very good indication for us to go in for a buy. And if we get weak retail sales, that will be an indication that we should go in for a sell, rather a buy, and we should see Euro USD recovering back to this level. If it fails to break this structure here, then that simply means that we should see a sell coming in and potentially taking us lower back to this level and creating a lower point. But I do not see that happening, but let's just give it some time and see what happens. So I think that's really it for today's snapshot. Let me just quickly see if we have a few questions here. Okay, hi, Saves, how are you doing? Just Squad, it's been a minute. How are you doing? I hope you're doing awesome. Apollo, hi, how are you doing? Yes, we're live. Joe, good morning. How are you doing? Oscar, hi, Oscar, how are you doing? Apollo, you're saying, when you talk of COT positions, does it incorporate the volumes and other positions open or filled? So Just Squad, the COT report is a report which is in full. COT stands for Commitment of Traders. It's released weekly by the CFTC. And that information is important for traders because it shows us where the bigger side of the trade is. The positions which are catered for in that report are all net open positions. Okay, so we call them net speculative positions. That's what we call the trades that we see in the COT, okay? And that report is important for most of you because it will guide you on where the bigger part of the futures trade is. And of course, you know that the markets are interlinked. So if you're trading CFDs with FX Pesa, the impact on any other asset has a spillover effect to whatever you're trading, okay? Yeah. That is all for today, guys. I wish you all an amazing time. Let us catch on next time. Doreen, you're saying which EMA have used for the indicators? I use the 50 and the 200 day, and I use them only for swing trading opportunities. So whenever I get a crossover on higher time frames, it just usually shows that there's a potential change of trend, and I will normally want to swing during that time. The link for getting COT reports is tradingstar.com. So it's right here. You can use that link, Apollo, to get those COT reports. So the reports are released weekly. And right now, the most recent report is for 9th. Okay, cheers, guys, and I wish you all an amazing time. Hey, yesterday the news came in negative, but gold went on a buy for almost 3 minutes, then down. Can you explain what record that way? Okay, 3 minutes is a very, very short time for me to interpret what exactly happened. So I think maybe I might need better context, but we can discuss then maybe Prince John, let's discuss maybe in the next snapshot what happened. So it could be maybe just normal price action. Yeah, 3 minutes is a very, very short time, so it's likely just normal price action. Okay, that's it. That's all, guys. I wish you an amazing day.